everybody. How's everyone doing? Hi, Kevin, Ziggy, William, Val. Everyone doing okay? Pretty tricky action in the pound yesterday. And looked like we were going to break down before all the news broke. Definitely shifted the move and my view in Euro pound. So this is what I'm talking about, holiday markets. This kind of action happens here. I went short Euro pound down here, and looks like we have a two driver here. So some of my original thoughts yesterday ended up working out okay. Hi, Blake. I hear someone on the mic.
All right, that's me. Sorry.
That's okay, buddy.
Good morning. How you
Good
doing?
morning. I'm doing good.
I'm fumbling around. That's it.
All right. So EuroCAD to me looks like it rolled over. This is a pretty nice non-confirmation. Maybe we have 50-80 in it. This is counter trend, but this was the third drive. One more stop hunt. RSI diverged pretty good. Euro Aussie came off, but went right to the moving average. I think there's another shot up in Euro Aussie. EuroCAD looks to be a little bit more vulnerable. There's an alert on here. Everyone see this? You don't have to agree with me, just so you see it. That's what I'm doing, is providing a view, so I want to make sure you have the view. Hard for me to want to be short Euro down here, you know, with the views that Grega has, and just the team that the dollar is negative here. I'm not ready to buy it either. So in these holiday markets, there just is not a lot for me that I see. I mean, everything's going parabolic, S&Ps, Bitcoin, and a lot of choppy action. I think the pound's indicative on just a regular day where news comes out with Carney and you had a breakdown, and within one candle, all of this reverse. Now, keep in mind that earlier in the week, we identified, and Blake identified, a shorting area in the pound up around 4.5. So just because it didn't fail here, and if you took the trade, there's no way you should lose money when you have 100 pips made, and this was over 100 pips from Monday's high. Okay, maybe you gave back some of your profits, but anytime you have a lead like this, if you still give it all back and make money, you really need to shut down your platform for a while. Never let a 100 pip trade turn into a loss. First of all, you take partials. Maybe you didn't ride it all the way down. Then you pull your stop down to BE. And now we might even be approaching another selling opportunity in the pound now that we're up here. And even Grega the other day said, although he has a negative look in the pound, he said, be careful with short pounds. He thought that we could still have another jiggle to the upside, and I think that's what's happening here. Aussie under pressure today. I'm not sure we're going to make a new low or not. I can't get short here. I'm not ready to buy it just yet. I needed to do something right. I'd like to see it put in a higher low. This might be a decent range if you're interested in the Aussie and you're wrong under the lows, probably close to the breakout. This is where we broke out. So if you get a reversal candle here in Aussie before we make new lows, you could probably go with that. So I've learned over the years that if I don't have a lot of conviction about anything, just to go, just to try and entertain my audience. You did? Okay, great. Okay, so just because you guys are here, rather than worrying about entertaining you, I'd rather bore you than mislead you with ideas. So if I don't see a lot to do, hello, Luca, I'm not going to, you know, make up trades so that, you know, you guys have something to do. The good trades hit you right in the face. Sometimes I come in here with a clean slate, and then after listening to Blake, listening to Steve, maybe Grega stops by, things clarify for me. Have you guys ever experienced that? You come in here in the morning, you go, you're going from pair to pair, you're going through all your screens and you're going, I don't know what to do. I'm not sure about this. And then after listening to the team or some charts that the community puts up, something goes, that's interesting. And that's something that's on my radar screen. I know that happens for me every day when I listen to the team. And that's the advantage of a live social trading environment, that you could come in and not know what to do. And within 30 minutes or so, you could have some compelling ideas to consider. So thanks for being here. Thanks for being smart to do intelligence gathering. Okay, you're taking only confirmations, not trade signals, right? So you have your own ideas, Madris, and then if you see some type of confluence from other people, it gives you more conviction to pull the trigger on the trade. I'm just like that, buddy. So we're kindred spirits in that way. We're all independent thinkers, but we all only have two eyes. So with that being said, thank you. Our mission every day is to build up and edify traders. That's what we try and attempt to accomplish every day we're in here. So with that in mind, I'm going to pass the baton to Steve Volge. You're very welcome, Tom. You're welcome. Glad to teach, Tom. Good morning, Steve Volge.
Hey, Dale. Good morning.
Hey, buddy. Hey, buddy. So before you get started, I just want to let the community know that our guest today, and I know there's a lot of hype on the internet, and I don't know what to make of it, the de-dollarization. He did an interview with Raul Paul, has a service called Real Vision. In fact, I interviewed Raul here. Have interviewed him a few times. And, a lot of people are looking at what the Chinese are doing with their new oil exchange that's traded in yuan as an attempt to de-dollarize at least the petrodollar. So should be an interesting interview to talk to him today. Luke Roman, perhaps even Blake knows him because I noticed he retweeted that interview, so maybe Blake's familiar with his work. So
I'm actually not.
Okay.
I just want to chime in there. I'm actually not. He looked like a very interesting interview.
Okay.
I'm not on Twitter as much as people may believe. And every once in a while I'll catch, like, if I catch one of your tweets and I'm like, oh, that guy sounds interesting, I'll retweet it. That type of thing. It wasn't I actually had no idea who he was, and I started following because it looked interesting.
I got lucky that you were looking at Twitter on that one.
Yeah, and but he's here today, right?
Mm-hmm.
It sounds like an interesting person to interview. So
Raul Paul doesn't put on any slouches. I mean, he gets names that I have a hard time getting sometimes. So I offered to trade guest books with him. So, Steve, what do you think about probing Aussie here? Do you think we're going to make a new low here? It looks somewhat tempting to me. Looks like we're about 61.8 back, 78.6 back. Be interested in. I know yesterday you said it wasn't red yet. You were neutral.
Yeah, things with Aussie actually are quite clear.
Still bearish.
Should I grab the screen?
Yeah.
Okay. Things with Aussie are quite clear. It has been a very, very easy pair to trade lately, and the reason is only one. It's because it has been holding this descending channel that we also saw a few days ago like a champ.
Yeah.
So and not only that, it has also been holding levels like a champ. So for example, when we were down there, we drew this because we said that, listen, 77.40 and the channel is like critical to any rebound. That's exactly where we got. Now, when we were rebounding here, we said that, listen, we see the possibility of a rebound higher, but if that can only happen, if we manage to clear this channel and the 7630 area to the upside.
Okay.
That didn't happen.
So far we have a higher low. We'll need a reversal to the upside for that scenario, at least to be a C, right? A little ABC or something. We can't make the lows here. So if you were an Aussie bull,
yeah, do you see the
risk reward isn't bad for a bottom pick, although it's, you know, who knows about the probabilities, but you're still looking for your 75 big round number.
I was initially looking for 75. It looked like that we might not get it, but you know, as long as the channel holds and this 61.8, I'm mentioning it, although it's broken, because as you see, it actually acted very nicely as support there, and then it acted as resistance again. So this 7630 area is quite important. So unless we clear that area to the upside at least, you know, for me, there is absolutely nothing bullish here. Nothing. I mean, we came close to doing that, but we even cleared that level and the channel intraday, but exactly as would happen with the Guppy, because I actually mentioned the Guppy yesterday in the chat room, and I said that the Guppy is one of the charts I will pin down as one of the many examples you see out there I haven't changed this line at all, of how important it is to wait for daily closes.
Okay, and kudos to you on the pound, because, you know, Blake top ticked it on Monday for about 100 pip or 120 pip decline, and then the reversal yesterday, and you were showing a triangle there too that it held. Look at where it went right there. Great call.
Yeah, so, as I said yesterday, you know, for me to get confirmation that this might be something, I really wanted to see a daily close below 132.50, because unless or until I did that, you know, I had absolutely no conviction. And today we actually came to test this huge descending trend line. We can see how important it is. I mean, it dates all the way back to the 2014 highs. We came and tested it to the pip before pulling back a little bit. But one thing is for sure, that the cable is getting to the point that it's testing major levels, because here it's also the confluence of the 61.8 of this move lower. Okay, so for me, that's how I had drawn it. And you know something, it doesn't mean that sometimes, you know, an interpretation, a technical interpretation can take, you know, multiple ways. I mean, and sometimes on the same chart, you can draw a couple of different technical formations, and or your eyes might initially spot a specific technical formation, which for some reason you just want to stick to it. Okay, and experience usually, you know, as time passes, makes you a better picker on what technical formation you believe is there. Obviously, on occasion you also spot some other technical formation, or you see a chart that somebody else posted that has one, and you say, oh, probably that's, you know, that's a better interpretation. But, you know, as a technical analyst, I like to stick to what I had drawn. So for me, that was a valid triangle here. And the breakout from the triangle, you know, was something that I was willing to keep respecting, despite seeing the possibility of other interpretations. And yesterday's, you know, retest probably proved to me that, you know, it was of importance. Now, what is undoubtedly of importance is this descending trend line that we talked about. So I think that we might have some very interesting days coming ahead for the cable, because we'll either see like a big rejection from here, or if we see a breakout from there, I would expect that we should see some, you know, some acceleration, because I'm pretty sure that we are not the only ones monitoring at this trend line. So, hey, Steve, you know,
I just wanted to excuse me, mention to you, you know, it is as good of a call as I made a couple of days ago, and I'm just saying that just because that's what Dale had mentioned. By the time I could get back to my computer, I ended up closing that for barely a gain. And but now it's, I mean, the risk is a possible turn higher, especially with that big candle that we saw yesterday. I mean, the daily candle that you saw there, that was a that in itself trapped a lot of people on the short side that were like me, that were on the short side. And you know, if we have any dollar weakness, especially following, you know, in 15 minutes we have GDP numbers. If the U.S. GDP comes in light, I mean, that might be the catalyst that throws the pound kind of into a tizzy. I don't know if it's going to, you know, I don't know if there's anything structurally, fundamentally that's changing regarding the Brexit situation, but there is without a doubt a very big short position in the cable, you know, longer term institutional shorts that could get squeezed a little bit. So I think the risk is now to the upside, but we'll see. You know, obviously, you know, we're, as you're pointing out on your chart, you know, we're within 50 pips of major resistance, you know, that we have to close above.
Absolutely. And
anyway, I'll let you continue on.
That it's going to squeeze if we actually break through that area, if we decisively break through the 134 area. I think there's a good chance that it's going to squeeze higher and get people completely chopped up, because as you said, there are still a lot of short positions here, a lot of them. And to be honest,
there's probably still a lot of people hoping that the dollar doesn't make a new low too, Steve. So, you know, you probably still have dollar longs trapped. I think the chart looks like,
oh, for sure,
duty, and you know, that we're headed to well under 92. So it's hard to be long the dollar against anything right now.
By the way, speaking of the dollar, the DXY is approaching a resistance area. You can see it. You can clearly see it here, actually.
Yeah.
First of all, we had this weak close there, but as you see, there is a little descending channel that we have been respecting so far, and we actually rebounded from there. The confluence of that channel, I wrote that in the analysis yesterday as well, the confluence of that channel in the 61.8, and now we are headed to backtest the 38.2 area and the resistance. So I'm really interested to see how the dollar is going to react there, because if it actually gets rejected from there once again, then, you know, I would expect more weakness piling in within the next few days. So yeah, there is a real danger for the DXY to. We've seen 3 days of somewhat of a strength, but you know, there is a real danger that it might actually resume lower pretty soon. Obviously, at a big extent, this is also up to what the euro is going to do. So if the euro is to rebound from somewhere here, then we should see that leg lower in the DXY and the resumption lower. But we need to see a rebound from the euro, and you know, we need to see it quite soon. Regardless, I still remain a lot of pressure. Yeah, I still remain constructive on the euro USD. I mean, I see absolutely no reason why it would roll over from there. Anything can happen on the market, but I think that the chances are much higher for a resumption higher. By the way, there is another chart I mentioned yesterday, if you remember, that I'm monitoring this as a possible triangle in the USD CAD, which would imply push to new highs. And so far today, we seem to be breaking above it. Of course, as I said, and I showed with the gappy, because the gappy, I bet, got a lot of people. Nothing more to say about the USD CAD, by the way. I covered it yesterday. I said that I would be looking for 130 if we actually confirm a break out from the triangle. So, you know, that's exactly my thesis, but I want to go back to the gappy because I showed it before. But what I didn't say is that, you know, I need to remind everyone that the gappy was coming down to retest a major area after a big breakout here. It seemed to be breaking down one day there and yesterday intraday. But as far as we know, this can easily be a triangle, and it might easily end up breaking to the upside. Regardless, this horizontal support area did hold for one more day, at least on a closing basis. And as long as that's the case, as I've read in analysis multiple times during the past couple of months, you have no reason to be bearish. I mean, you might be viewing this as even when we were dripping lower like this, and the gap was looking very, very heavy, I started having the feeling that it's going to break lower. But from having that feeling to actually making something actionable, as long as you have this like huge support area holding so incredibly well, it's something that you should stop yourself from doing, because it's an impulse. It's a psychological impulse that, as you see in this case, and that would not be the exception, would probably not end up spicing up your account, right? So we are once again in the middle of this triangle. Momentum is strong on the other hand, so I would say that there's nothing to do here, but momentum suddenly looks strong. I mean, we've already covered within a couple of days price action that dates back to a couple of weeks. So actually in a couple of days we already engulfed a couple of weeks of price action. That tells me a lot. Okay, let me see what else we have, and Blake will jump on. Blake, feel free to jump on whenever you like, by the way. We're also seeing a decently strong rebound in the USD yen, by the way. But
I'll be here after the news. Yeah, remember you got GDP numbers in 8 minutes.
Yes, and I'm guessing they're gonna show us if these moves we're seeing currently, for example, in the USD yen, are something that was worth paying attention to, or what else. But one thing is for sure, the USD yen is attempting a break above this support area that now acted, temporarily as resistance. We're now intraday at least penetrating through this 200 DMA once again. But let's see, what the news are going to bring and how we're going to close the day. So we're going to revisit that. You're going to revisit that with Blake actually after the news. Now, having to do with the IWM, because I forgot to comment on that. You mentioned it yesterday. I was having arguments all the time, and on Twitter as well, about the nature of the move lower. I believed it was corrective and it was a megaphone formation formed exactly like this. And it proved to be just that, a consolidation. We broke above it, we retested it, and we're accelerating higher. So there is nothing bearish with the IWM. Also, there is nothing bearish with the SPX, which managed to break yet again above one more ascending formation, this ascending channel in this case. Now, I don't know what the target is, because the only thing you can be doing when something keeps breaking to all-time highs, unfortunately, is project from fib extensions of the last corrective move. Unfortunately, the last corrective move here was a minuscule corrective move, and targets we get from here is anywhere between, I would say, the 227 and the 2618 at 2,648 and 2,662 look like good levels. But honestly, I mean, indices are going parabolic. They're breaking, one ascending formation after the next. Obviously, there is no questioning about, if they're bullish or not. And you can't even be sure about how long or how prolonged this kind of move is going to be. So you're just targeting one level after the other, and whenever we get some kind of technical formation as we got here, sometimes we see like short pullbacks, but the fact remains that momentum is very strong, and any drawdowns have been, negligible, honestly. I mean, since the low of the election day, we've seen very few corrections that have lasted for very few days and have retraced a very small percentage of the move. We are already, from last November, for example, in the SPX, we're already, what is it? Almost 30% higher. And that's at a market that's on a 9-year-old bull trend. There is absolutely no question.
Quite a few months ago, Blake said that he was going to look for a blow-off move into the tax bill passing. It looks like that's what's going on.
It is likely. It's really funny that the market keeps racing with the expectations of a tax bill, which, first of all, we haven't seen yet, and second of all, I'm pretty sure that, the best case scenario for that tax bill is already priced in. But anyhow, let's be honest, in such raven bull markets, the market is always looking for excuses to be rallying. And at some point it wakes up to reality, and suddenly, all the bad news or all the mispricing that it had been doing starts mattering. And that's how you get the strength that we see in bear markets. Bear markets last, on average, statistically speaking, around a quarter, a fifth of how much bull markets last, sometimes less, but on average, I'd say about a fifth. But usually manage to retrace a huge chunk of what a bull market has produced in 5 times the duration. So, for example, it would really not surprise me when this thing blows out at some point to see a 9 or 10 years by then bull market getting within a year retracing 50% of what it did in 10 years. Because that's how it works. That's how it works. So, obviously from the standpoint of where you should be having to do with stocks, is that you should usually be long because the vast majority of the days of the year, it's going to go higher. But when it blows up, if you get caught being trapped long, you're in real trouble. So that's how it is. And I have to say, on the other hand, that neither the DAX or the Nikkei are confirming this move yet. Okay, and to be honest, in the DAX, I'm still looking as a very possible scenario, another leg lower from anywhere here or a little bit higher. The same thing applies to the Nikkei. So we have a decoupling from there as well. So let's see. I wouldn't be long these two indexes yet, for sure. So let's see. Luca went long yesterday, from what I know, the IBEX, and that proved, or sorry, a few days ago, that proved quite a nice trade. I mean, we've had a nice gap higher today, and it's been rampant the last 3 days. So this is a formation I'm still looking at the IBEX. But we don't have confirmation yet of a breakout, but it is an interesting formation. And now having to do with the FTSE, because we haven't shown it in quite some time, I have to say that we're still in danger of a double top up there. But on the other hand, we haven't done any real technical damage to the downside. So we're currently testing resistance though, and I have to say that this appreciation that we've seen the last few days does not look impulsive to me in any way or fashion. Okay, this move higher does not look impulsive to me. So especially if we see some cable strength coming through the market, I would be very careful with the FTSE. We have news in half a minute, Blake. Yeah, I think it's half a minute. So let's see what we get. Yes, Luis. Okay, let's see. USGDP 3.3 versus 3.2. So it's good news. It's a slight bit of what was expected. Okay, the USD yen had already reacted to the news. Now I don't know how you want to interpret that, but it doesn't seem to be doing anything since we got it. Let me check at the cable. I'm not seeing any real reaction from the market actually. So the market barely reacted to it. No, almost no reaction. Okay, so that was a positive reaction. Quite a good GDP print actually. 3.3 for third quarter, not bad at all. Although I have to say that during the past few years, and I have been discussing that in the past with Stelios, we are seeing stronger prints during the second and the third quarters, and usually we're seeing softer prints during the first and the fourth. So for me to confirm that the US growth is actually accelerating, I would really want to see what the fourth quarter brings, having to do with GDP growth. Okay, let me start going through questions, and Blake should be with us very soon. Question about the S&P and the Russell. I hadn't seen it, but I covered them. Why Kiwi and gold are strong and Aussie is so weak? First of all, let's have a look at the Kiwi since you mentioned it. I wouldn't say that the Kiwi is too strong. Yeah, it was stronger than the Aussie for like a few days, but if you see, I mentioned yesterday this descending channel that might act as resistance, it actually did. So looking at this chart, I wouldn't call the Kiwi strong. It's just temporarily stronger than the Aussie. Now, having to do with gold, I wouldn't call gold strong as well. It got rejected from the channel once again. Actually, let me redraw it to be perfect. There it is. And I warned yesterday, having to do with silver, I warned about gold. People in the chat room, I said that, listen, gold might be rejected now simply because silver is pushing lower. I actually also, good thing for reminding me, I actually also wrote yesterday on the chat room that I already sold some silver just to put my toes in the market. My entry is at 1684, so I'm already somewhat in the money, and I'm looking to add to a full position. I will add another third once we break below this support area, and then I might add another third, perhaps if we see something like this. Although I have to tell you that I might not even add another third here. I might actually do it in gold because I like the reaction of gold from where we're getting it today. So I might end up making a mixed position between the two metals, like 2/3 silver, like 1/3 gold, something like that. That also crosses my mind.
So Steve, you notice how the dollar strength that we had, most of it was ahead of the advanced GDP.
Yes, and I said it actually. I don't know how suspicious it is, but we got the reaction of the bid before the print, and after the print, absolutely nothing, no follow through.
Yeah, and pound has not sold off. Actually, the pound is still holding up very, very well, which that's a risk. If you're short the cable right now, you're probably going, oh crap, that's not good news. So I think that if the dollar,
I gave you the screen, by the way.
Yeah, if the dollar comes off here, the pound's at risk of a probe up into the highs, and this is really we've had these stupid dotted lines on the pound drawn for, I want to say like 2 or 3 months now. Well, the upper trend line's been drawn for is probably as long as we've been doing the face webinar, but the lower trend line really over the last couple of months as we've been winding up here. So if the dollar comes off at all, you know, the risk is that the pound could pop its head back above 134 and maybe even a high. So you know, but the dollar is holding up pretty well. I've thought, you know, the last few days that the dollar yen would get up towards 112, and here we are at 112. I am selling a little bit right now. You know, getting on the short side. I think that, you know, we have obviously a little bit more room here. If we really want to push up towards the 112.20, it can happen. But, you know, as far as I'm concerned, this is just a recovery in what I think is a more of a downtrend. And so I don't, like I said, I don't mind being short, and, you know, we can make it up towards this 38% retracement. Actually, here, I'll just do this. We can probably head right back up to here. And I don't see any real problem with that. But if you're like me and you're shorting the US dollar, Japanese yen up at these, you know, levels around the 112 level, you have to understand that we could make it up towards there. But you know, the real big move was in the cable overnight, well, yesterday. And so let me talk a little bit about the pound and kind of what happened yesterday. So Dale's like, Dale said earlier, you know, I nailed the high. I did, but also if you notice, I had to get out of my short trade and our pattern in play yesterday when we hit one, you know, we were at 133.36 by the time I sat back down at my desk. I was actually out running some errands because my wife needed her computer. I had to run her computer over to her office really quick, and she had accidentally forgot it, and so I had to run it back over to her. And so this all happened obviously while I was away from my desk, which I laugh about it. This stuff always happens when I walk away from my desk. It, like, the market doesn't do anything, and then, you know, when I step away, it happens. But when I sat down, you know, I closed out my pound short, and one of the things that I did yesterday is I shorted the euro pound. Now I shorted the euro pound, which means I'm playing the pound to the long side. I already knew that the pound dollar was at, you know, or near major resistance, which, you know, made me a little skeptical about being long the pound dollar per se. But I shorted the euro pound, and one of the traders in our chat room, and here you guys can say hi. I'll put you out here. This is our, you know, there's 85 of us chatting around. You can see we're all just you know, whoops, I didn't mean to do that. We're all very active in the chat room, you know, posting charts and nice little GIFs and whatnot. And you guys are on Jumbotron, so you guys can say hello. Yeah, yesterday I said I'm going to short the euro pound, and one of our traders in here, JT, who you can see right here, he had asked me, he goes, "Hey Blake, sometimes you a move has already happened, yet you still get in. Is that not chasing?" And that was actually a really, really good question, because normally I won't chase, but if I feel that there's a potential or there is a trend changing news event, or in this case it was an announcement about the EU and the UK possibly settling their disagreement, if you will, or agreeing on the amount that the UK is going to pay, that could be a potentially nice. That's good, Bill. I like it. What is that? That is a big soda drink. But I was I told him if there's something that I think that could be potentially trend changing, I don't mind being in the market. And that the news yesterday that hit the market about, you know, the UK and the EU could possibly turn the table and turn the tide rather, and then actually let the pound break out. And so I did short the euro pound here, guys. I'm going to get rid of you really quick. Sorry. And so I did short the euro pound. Now I didn't put in a pattern play because there really wasn't a good pattern set up other than we were in the middle of this, bearish wedge. But I also like to trade if I can get myself in a position where I think longer term we might have a break. So in regards to the euro pound, I'm showing you this chart because I may be in a in a position, but it's only a half-size position because I'm going to give you guys my plan of attack here on the euro pound.
It's already a pattern in play near the highs from Nick too.
From Nick,
yeah. Do you ever duplicate the same pair that someone has on, but you see something a little shorter term and you do another pattern in play? I don't think I've seen that.
No, it does, and it does happen. Actually, we as a team sometimes not. It's more coincidental, not like we talk about it.
Right.
But every once in a while, like I just in recent memory, a couple weeks ago, Nick and Grega both put on a pattern in play, and Nick said, "I'm going to put on this pattern." I forget what it was. Nick said to our group in our chat that we have amongst our team, she said, "I'm going to put in this pattern in play before Grega does, because I know he's looking at this." And then Grega chimed in like, "Oh yeah," but she had already put it in. So she knew that he was going to already be looking at this, and so she tried to jump the gun and get in before him. But we've done it before. But looking at like her pattern in play that she had from a couple of days ago, it just reinforced my decision to be on the short side. I just knew that I had a worse entry. But the way I'm looking at this is, if you look at the euro pound like a longer term, this is where I have to take a step back a little bit and go, okay, I'll start with an entry, which I did yesterday, but I know in the event, and I'm going to draw this out for you guys, in the event we break through here, okay, a couple things happen. And this is, as you can see, this is a bearish wedge, right? We have consistent lows and lower highs. So that's a real basic bearish wedge pattern that we may do this before breaking down. But the risk is, I would say, if I had to throw a percentage on it, I would say there's a 65%, and excuse I'm trying to freehand this, 65% chance that we drop and a 35% chance that we rally. Okay, when you see a bearish wedge, that means lower highs, consistent lows. Now, what also is at a risk here is you got a big possible double top and breakout, and false breakout. So this is a false, right? I'm trying to, this is all with freehand on my mouse. So you have, see, we have a false breakout there, possible double top. So if you get short, and Nick had the better price, obviously, but if you get short the euro pound and it breaks through here, then you add, right? So now you have a nice profitable position that you can actually move your stops to break even. And let's say you get really lucky. Let's say the pound, something phenomenal happens out of the UK where the pound just gets this massive bid, and then the euro breaks down and the euro pound actually breaks lower. Then you break through here. Then you have a huge, possible double top that leads us way lower. I mean, I'm talking long term. I'm not talking like this is going to happen tomorrow. I'm talking this could really take place over the course of the next several months. If I can get into a position where I can start off a trade and it looks, like yesterday, it looked pretty good. I knew the pound already was showing a big signs of reversal. If we really break this over the course of the next 2 or 3 months, and I have a nice cost average of, let's say, 86 or 87 pence. Let's say my cost average is somewhere around here. And over the course of the next several months, we head down towards the mid 70 pence level. That's a home run. And I try to put myself in a situation for a home run. It doesn't mean that I'm gonna get them. And home runs for me, and I'm talking for me in general, the way that I trade, and it doesn't necessarily mean it's the way that you trade or how it happens for you. You know, I have a couple 2-3 home runs throughout the course of the year that usually make up a quarter. What I mean by that is a big trade that really makes my quarter. Like, that happened, holy crap, I made a lot of money, and I made up, you know, a lot of my year in just one trade. And if I can set myself up for that, you know, on a longer term basis, I will. And if you look for where, and I'm going to erase all this. If you look where we're at right now, I mean, that's a long shot from, like, you know, we're at 88 pence or 88 and change, getting down to like 80 or 77 or 78 or somewhere down here. You know, that's a long way to go, and that's a lot of foresight to see that. But, you know, I'll just give you a recent example of what I did. You know, you guys, if you read the blog, you've been sitting here on the Face webinar for the last, you know, 5 weeks, and I've been shorting the US dollar Japanese yen at the 114, 113.80 level, and I covered it all last week. That trade right there made my entire quarter. So just so you guys have some perspective on how I traded that. Okay, that trade right there, that made up for a couple little losses in the euro yen. It made up, and I'm not talking about like all my other trades. I'm talking as if you look at my entire quarter of how I did this quarter, my entire quarter was made up mostly of that US dollar Japanese yen short. And you can come back at me and say, well, Blake, you were early. Well, sometimes you have to be able to see the forest, you know, behind the trees. You have to look behind that tree that's right in front of you and see what lies beyond that. And that's why I look at the euro pound and I'm like, okay, let's say that something spectacular happens between the UK and the EU, and Brexit gets done. I'm not saying it's going to happen, but I'm going to put myself in a situation where if I'm short the euro pound at, you know, 88 pence, or, you know, if I got a better price, which I didn't, that Nick did at, you know, 90 or whatever, and the euro pound makes its way back down to 82 pence or maybe 80 pence or, you know, lower, you got yourself a really, really good longer term trade. And if I can keep myself in a place where I think about what could happen in the future, then, you know, you set yourself up for those types of trades throughout the course of the year. If you have been listening to you know, the Morning Edge webinar, many of you listened to me for, you know, 10 years, 12 years on our free webinar that I had with the Wise Trade Group. And some of you would be like, you know, would be floored that I'd make 1,000 pips in the pound New Zealand over the course of 2 or 3 months, or, you know, doing trades like that, the dollar yen, riding it from 80, you know, when it went from 80 to you know, it hit I think it hit like 95 before I got out, like this move right here. I set myself up for that because I was looking longer term, and I kept that longer term viewpoint in my mind the entire time, you know, when I made this trade. And many of you remember that, and many of you that are listening in right now that were listening to me back in, you know, 2012 rode that trade with me. And you
I
know,
call those campaign trades, Blake. It's like a military campaign, you know?
Yeah.
It's not just a skirmish, it's a campaign.
Yeah, and yeah, that's a great way to that's a great analogy and a great way to look at it. And no, but believe me, not every trade is like this, and actually very few trades are like this. But when I know, like, I'm going to go back to the pound dollar. I know for a fact, and well, for a fact in my mind, and that doesn't mean it's, you know, it's actually a fact, but in my mind, okay, I know that we're consolidating here in a triangle, and I know that a breakout is coming. Now, hopefully, if things work out the way that I assume they're going to work out, this breakout from this triangle can yield a pretty big move. You know, whether that puts the pound at 140, 145, or if it breaks lower and it breaks through 130 and we go to 125 or 120. I think that this consolidation that you're seeing here in the pound dollar, it's going to yield a pretty big move regardless, okay? And I want to be there for it. I want to be there participating. Will I buy the pound US dollar? Maybe. I mean, I might. I have to. There's other things that have to happen in the U.S. Like, let's say like I'll give you an example. Let's say, and it looks like, you know, the tax plan's gonna pass, but let's say it fails somewhere, it gets tripped up somehow, and the dollar gets crushed. Well, the first thing I'm going to look at is the pound dollar, because I already know that the pound's set up, all right? Or let's say we get this massive buy the rumor, sell the news. You know, stocks rally, then they reverse, and they reverse hard, and then the dollar gets, you know, bulldozed. Well, then I'm still going to look at the pound dollar as being a good possible long. I mean, there's, you know, I want more reason to be long, you know, the pound dollar. Like, and you might say, well, Blake, you're short the euro pound. That's because I'm not completely convinced that the euro is, you know, going to 130 yet. I think the euro had a epic run this year, and the euro might come back a little bit, or maybe we'll just stay sideways. So I'd rather play the euro pound when I'm more questioning the dollar and what the long-term outlook of the dollar is versus the euro. The euro, I think, had a really nice squeeze, but might be more sideways. The dollar is more of a wild card to me. So hopefully, you know, those comments on how I'm approaching the market, hopefully that helps you out, and it helps you out where my mind is in the euro pound. And I could be wrong. I know. Let me ask you this, and I'm going to ask the viewers, Dale, not you, okay? Because I don't want you to answer. If you look at the euro, if you look at the euro pound, and this is the first question you have to ask yourself, and you're short, where are you wrong? Because that's the first thing I ask myself. Where are you wrong? Where? Nitish said, I rode that trade like Matt Lauer's girlfriend. Dude, that man, that hurts. That's sorry. I had to read it down.
Someone's going to sue him for sexual harassment.
Yeah, right above here. So right above here, like the 89. I'm wrong if we get above 89.50 or 60. But see, I know where I'm wrong, and it made more sense yesterday when we were trading at 89.30 or 89.40 where I got short. I got short somewhere around here. So, or no, excuse me. Let me see where my cost average is. Hold on. Give me a second. My cost average is 88.92. Okay, so 88.92. So like right here. Okay, right where my cursor's at. So I know I'm wrong here, for sure. And that's, you have to know that. And I'm like, okay, well, if I'm wrong here and the potential is somewhere down here longer term, I'm good with that. I'm good with it. I'm good, right? Patricia said too soon. All right, good. And you guys kind of got where I was going with this. I have to ask myself each and every trade, where am I wrong? That's the first thing I ask myself. Not so much what can I make, but where am I wrong? And that's the first question that any trader, any investor should ask when they're buying or selling an asset. You know, and it brings me to the topic of Bitcoin. Bitcoin is at you know, oh my God, we're at 11,000. Holy crap! And going. We're at 11,000. Bitcoin's at 11,000. Okay, so if you're buying Bitcoin, and I'm doing this theoretically because I don't own it. I've told you guys day in and day out, you know, hey, I missed it. I can't buy it here. I'm gonna miss it. I'm missing the train. It left without me. So be it. But you have to ask yourself right now, if you bought Bitcoin, where are you wrong? I have no idea. Like if I bought Bitcoin right now, like let's say it was me, and I was saying, okay, screw it, I got to get in because I've got the fear of missing out. I got to get in, which is absolutely asinine if you ask me, because I would never do something like that. But if I did, I bought Bitcoin. Where are you wrong? You tell me. Below 5,500? Right there? Below 8,000? What kind of risk reward is that? You know, because I look at it at where am I wrong in this trade? Am I going to buy it at 11,000 and then sell it if it breaks 10,000 again? Well, if that's your play, that's your play. You know, what are you looking for? Are you looking for a move to 20,000? Great, so be it. You know, but you have to know where you're going to exit. Like I have to know. It's like I know where I'm going to tap out, using a wrestling metaphor or analogy. You know, I know where I know where I have to, where you know, where it's painful for me. And so as long as I know that when I trade, I'm fine. But if I can't gauge that, or if it's way too far from where we're currently at, I won't do it. And that's like where I look at Bitcoin. It's like, okay, if I bought Bitcoin right now, I would say realistically, if this was me, like this is where you're wrong. If you bought it right now. But what kind of risk reward is that? You know, am I willing to buy it right now at 11,000 and risk 30% if it drops back below 8,000? Am I willing to take that type of risk? Not me. You might. Maybe it's the right trade for you. You know, it isn't for me. It's not the way I do things. So again, those are the questions that every trader needs to ask themselves before they get into any position, any asset class. And I'm not talking, you know, just currencies. I'm talking about if you buy an equity, if you buy Bitcoin, if you're a real estate investor and you're flipping homes. You know, at what point when home values drop, do you have to turn around and say, I have to get out because I can't take it anymore? You have to know where you're going to say uncle, you know, because you will be wrong. Correct, Dale? You will be wrong. I'm wrong all the time. So guys and gals, I hope that lesson.
Great mentoring, Blake. And really actually a great segue besides your part about knowing where you're wrong. Looking at Euro Pound and seeing the forest from the trees for what the potential is, because that's a great segue for Luke Groman, who's with us. That's the name of his website, The Forest from the Trees. So,
is that really? I didn't know that. That's awesome. That in itself is awesome. So awesome that I'm gonna have to stick around and listen in. So okay. Dale, have a great interview. I hope he's here already. And yeah. Okay, great. Then you guys have a great interview and a great trading session, and I'll see you guys tomorrow here on the Face webinar. So thank you.
Good hunting. Thank you, Blake. Okay, Luke, I see you. I'm going to make you a panelist because I'm not sure you're bringing charts with you. If so, then I'll make you a presenter, but at least we'll be able to hear you. And I'm showing your website right here. So nice to meet you, Luke.
Nice to be here. Thank you very much for having me on, Dale. I appreciate it.
Oh, it's great to have you. Did you bring anything you wanted to show? Because I'm showing your website right now.
Yep, I'm seeing that up there. You know, when you said interview, I just thought you'd, if you had questions, I'd be happy to answer them. I can,
Yeah, that's perfect. We can do audio, and I've taken a look at your website here. I love the name Forest for the Trees, because so many times traders get caught up in the minutia and the short-term views, and trade off 15-minute, 1-hour charts, etc. I'm interested in how you got involved in the industry and what the beginning of your journey was like at point A, and I'd consider where you're at now, point B. So can you tell us a little bit about your background?
Absolutely. So I've been, I started out in the business, almost 23 years ago, way back in 1995, in the research business. There was a old line Cleveland money management firm named Ralston and Company that had a small sell side operation, and so I started off in research there. And then was part of a very small group of people that formed Midwest Research in 1996, which was really a pioneer in doing survey work, channel checks, background, sort of real deep in the weeds, bottom-up fundamental research. We grew that business from 1996 through 2001, was made a partner there, and we sold that business to First Tennessee Bank in early 2001, and was renamed FTN Midwest, and grew that business further. And sometime around 1997 or 98, I made the jump over from research into equity sales, and was calling on a number of institutional accounts for the firm. 2001 to 2006 was at FTN Midwest, and in the late 90s, while still at Midwest before we sold the business, I was the one of the creators and the editor of a weekly product we would put together where I would aggregate a bunch of the firm's research and then also marry it with different macroeconomic and thematic things I was reading on my own time. And we called it The Herd in the Midwest, and it came out every Friday, and it quickly became a very widely read, very popular product with our customers. Continued that after FTN bought us in 01, and then in mid-06, myself and 20 other partners left over a weekend to form Cleveland Research Company. And again, I was wearing a sales hat there, and I had reprised my role as the creator and editor of a weekly product for our customers that was, again, putting pieces together, very widely read and by our customers, and was always complimented for my ability to put what seemingly disparate pieces together and figure out things or trends that might be occurring. That was something that helped the customers, the accounts I was calling on for the firm, tremendously in 07 and in 08. I was able to help advise customers to position well for what transpired then. Post 08, as the world became more central bank and macro driven, I was spending more and more of my time on those topics, and by 2013, approached my partners about focusing on some sort of macro or thematic product full time. And they said, yeah, we'd love to have you do that. My one caveat was that I wanted to have complete creative control to write whatever I wanted to write whenever I wanted to write it. And from a marketing standpoint, as a firm, Cleveland Research was still very well known for its very in-depth, in the weeds, bottoms-up research, channel checks, etc. And it just kind of had a hard time figuring out where they would place such a product in terms of in terms of a marketing standpoint. And so instead, we agreed to part ways amicably in late 2013. In early 2014, I hung out my own shingle as FFTT, Forest for the Trees. And what I do is I aggregate a large amount of disparate, publicly available data points in a unique manner in an attempt to identify developing economic bottlenecks for our customers who are institutions and high net worth individuals. Okay. And,
so you answered my next question. So originally directed towards institutions or people with a net worth of over what to be able to.
It's not an accredited product, so so it really is. It tends to our subscription prices tend to tend to be more geared towards people with some level of net worth to trade, to invest.
What is your, do you have, what's your monthly or yearly subscription rate? May as well get it out there.
So it is, it is $5,000 a year for an individual read-only, and then it's $10,000 a year for full, full touch, full subscription. We publish a report, every Thursday that's 8 to 10, 12 pages, and then also we do a pre-recorded webinar every other Tuesday, and then we also have sort of flash reports we put out when something grabs us that is important, we think, milestone, and something we've been talking about prior.
Okay, well, I'm familiar with Raul Paul. I've interviewed Raul a few times. He's one of the creators of Real Vision that you did an interview on, and I'm looking at your media appearance here that you did a interview with them, and what really sticks out to me is how you really focus on global FX reserves as being significant and the linchpin to that every other asset class spins around. Am I reading you correctly as far as your thesis on currency is really the largest market and has the largest impact on everything else, even bigger than bond markets?
Yeah, I think, we've really been focused on these FX reserve markets, the global FX reserves number, simply because it was such a big change, and it was very underfollowed, underappreciated by the street, right? So for 70 years after World War II up until the third quarter of 2014, throughout all the various crises and emerging markets, et cetera, that had been a one-way data item. Sometimes it grew faster, sometimes it grew slower. It grew very fast post '02, but for 70 years, FX reserves rose, full stop. And then in 3Q14, over the next 18 to 24 months, they fell roughly a little over $1 trillion, peak to trough. They've kind of stabilized where they are, but it was.
Why? Do you know why they fell while central banks were on a printing mission? Why they fell? Was it velocity, or it was the stock of money?
That is in a way a $64,000 question. The mainstream narrative is that they fell because oil prices began falling in late 14. And it was just sort of a traditional emerging market, commodity-driven crisis, right? Where oil prices fall, and so the amount of petrodollars in the system fall, and then these nations need to start burning down FX reserves in order to sort of preserve their currency valuations, and that I think there is an element of truth to that. The thing that I think is underappreciated is that remember, 3Q14, FX reserves peaked and began falling. Number one, in November of 2013, the PBOC came out and said it's no longer in our interest to stockpile FX reserves. So China, as much as the mainstream narrative of the decline in FX reserves, and and China was a part of this, was this was all defense. This was emerging markets being choked off by the strong dollar. It's very odd that China would announce 9 months before they peaked and began falling that basically, hey, we're done here. The second thing that is a bit of a fly in the ointment for the mainstream narrative is if you go back to 3Q14 also, you began seeing, and in theory, these FX reserves would be being sold down to relieve dollar shortages experienced as oil prices fell. The weird thing this time that had never happened before in at least 70 years and under the current system was that if you go back to late September 2014, in a very short span of time, you had Russia, you had Ecuador, you had Venezuela, all come out and say we're experiencing dollar shortages, which is curious because at that time, oil was still priced at between $95 and $100 per barrel. And so you've got these oil exporters who are all running current account surpluses. In other words,
Right.
in theory, they're only, they're selling, or they're selling more than they're buying.
Yeah,
so they should have net dollars inflowing. Exactly.
They should be very liquid with dollars.
Exactly, and they weren't. They were having shortages. And to us, the missing, at the time we wrote to our customers and said, number one, this is really bullish for the dollar. But number two, what's creating this? It shouldn't happen unless, these countries got wildly more corrupt over the last 3 months. In other words, basically the excess liquidity was being drained off at a massive rate by the politicians or domestic sector. Or alternatively, they're beginning to sell oil or settle oil in non-dollars. And interestingly, if you look back to 2Q14, there was this holy grail, what was called the holy grail energy deal or gas deal between Russia and China. And it was rumored that that deal was done in non-dollars. And so if you it was later confirmed that it was done in non-dollars. In August of 2014, Putin came out and said the dollar's monopoly in global energy trade is damaging the economy. We're going to move away from the dollar. And so long-winded way of saying, the reason FX reserve, we think the accepted mainstream narrative reason for the decline in FX reserves, the first such decline in 70 years, and the actual reason may be very different. And in the near term, it's sort of semantics because the outcome is the same. It's a deflationary environment, the dollar should strengthen. But the further away you get from 3Q14, and of course we're now into year 4 away from that, the real reason becomes less semantics and more important to focus on. And what we ultimately think, and what we think the preponderance of the evidence shows, is that it was because the world began to de-dollarize the global oil trade. And
so a main part of your thesis, this began to show up a few years ago, and now that, and this may be 2.0 of this, with China going to an oil exchange priced in yuans, convertible to gold, I believe. Is this the next step in de-dollarization from the petrodollar and the reserve currency?
Yeah, it's the short answer is yes. I mean, to be clear, it is what we think China is doing, because there's been a whole bunch of speculation on that this is a gold-backed oil contract. It is not. Okay. But if you look at what China is doing, it appears that they are merely reopening the Bretton Woods gold window at a floating gold price through yuan, or if you're really an economic history buff, effectively what they appear to be doing with gold is establishing an alternative economic currency system, effectively, using gold as the bancor that John Maynard Keynes proposed at Bretton Woods, where, if you recall, he had his proposal was not where the world ultimately went, but his proposal was you have all currencies float against the bancor, and the bancor is a neutral floating reserve asset that would float in each currency and sort of settle imbalances before imbalances got too big. And the reality was the U.S. had all the men's and all the guns and all the gold and all the oil, and so we just said, no, this is how it's going to go down. And we got the Bretton Woods gold standard. So, but what we think China's doing with gold is all about oil. Ultimately, we think it's a matter of national security for China to be able to gain the ability to print yuan for oil. To do that, there's two issues. Number one, few, if any, people trust the yuan more than the dollar, but just about everybody will trust gold more than the dollar. And so opening the gold window to allow settlement of offshore yuan imbalances created through the energy trade suddenly sounds like a really good deal if you are, Russia or OPEC, etc. The second point is that, if you settle imbalances in your currency in your sovereign debt, you end up basically jumping feet first into Triffin's dilemma, which we've seen here in the U.S., which is that if you settle your offshore balances in your sovereign debt, in the short run, you get, a short and medium run, you get a debt fueled consumer and government spending party. And in the long run, what you get is the bankruptcy of your country. But doing this forces you over time to have to offshore your production. You've got to send your jobs, your manufacturing jobs elsewhere. You have to run deficits. And that's why in the long run it bankrupts your country. And that's, I think, the other reason China is looking to gold, or why they've talked about SDRs or neutral assets really since immediately after the crisis back in 2009, is because they understand this. They don't want to send all those factories that have gone there somewhere else so that they can run the deficits needed to supply the yuan and yuan denominated, yuan sovereign debt or Chinese sovereign debt to settle yuan imbalances in the same fashion the U.S. has. So the goal is really about, A, getting trust, and B, playing the long game in terms of, look, we're not gonna bankrupt our country in the long run to gain the ability to print yuan for oil in the short run.
Okay, so sometimes markets that are going through a transition do so in a glacial manner, and you started noticing this in 2013, 2014. Here we are a month away from 2018. Do you see this beginning to accelerate that could create some type of tipping point? I know you talk about you're looking for the biggest mean reversion in 70 years. What do you mean by this mean reversion?
Yeah, so to me, if you look at what these big years are doing, what China's trying to do to gain the ability to print yuan for oil, becoming only the second nation to do so. When you look at what that has meant or has begun driving in terms of FX reserves growth, it's really twofold. It's number one, for the first time in 70 years, deficits are beginning to matter to the United States again, and nobody's paying attention to it. Famously, Dick Cheney, Vice President Dick Cheney, reportedly said in 2004, "Hey, look, Reagan proved that deficits don't matter," and he is absolutely right. For as long as global FX reserves go up and up and up ad infinitum, because effectively what that is, that effectively sterilizes U.S. dollar, U.S. deficit outflows. Right. So. Yeah. But the moment that stops, all of a sudden you start having, sort of the crowd, the legendary or the mythical crowding out effect of government spending that has never happened in the U.S. begins to happen, and we've seen symptoms of that, right? So you've seen the U.S. have to take steps that typically only emerging markets have to take. So in 3Q14. The United States, or the Fed, introduced high quality liquid asset regulations that effectively forced U.S. commercial banks to have to begin buying a lot more treasuries for capital requirements. That's a classic emerging market strategy. You begin forcing your domestic banking sector to fund the government through enticement of regulations, etc. You had money market fund reforms where guess what they had to buy? Again, enticed by regulations. U.S. Treasuries. They have to go out and seek different demand sources that they never had to. That's exactly right. And again, because it's the USA on the masthead of what we're describing. Nobody's looking at what's been happening through an emerging market lens, looking at the U.S. And what's happening through an emerging market lens. But if you do so, a lot of what we've seen since 2013, 2014 starts to make sense, and it helps give you some direction about sort of the potential outcomes. I mean, another thing that emerging markets in a balance of payments, pressure or problem have is the strategy is they start forcing some of their biggest expenditures onto the citizenry. And what's one of the U.S. government's biggest expenditures? It's healthcare. What did we get in 2013? We got the ramp up of Obamacare, where all of a sudden I know, for example, my healthcare premiums since 2014 have gone from $400 to $1,100 a month, and that says nothing about there's been no change in healthcare status. I'm a young guy with a young family. He's relatively young, and that says nothing about copays. So you see the U.S. government, force banks to buy more treasuries. They force money markets to buy more treasuries. They force more healthcare costs onto people. All of this serves to crowd out, as you would see in an emerging market.
Why don't they force corporations, instead doing stock buybacks to give the U.S. a hand? I
guess
with the new tax bill that may or may not pass, watered down, whatever, it doesn't look like this is going to do anything to remedy it. It may even exacerbate what you're talking about, don't you think?
Well, I guess it depends what happens to that cash. If they do this and it repatriates a bunch of offshore cash, we'll get what, we would in theory get what we've seen over the last, several years, the last, 9 or 10 months notwithstanding in the dollar, but you'll start to squeeze, you'll further squeeze offshore dollar liquidity, right, which should drive the dollar higher. But if those dollars come back here, they're going to get put in a bank. And if they get, to the extent they get put in a bank, what's the bank going to buy with them? They're going to buy treasuries. They get put in a money market fund, they're going to buy treasuries. So, I mean, again, if you sort of once removed, you can make a case that at least on some level, this is helping, this type of tax reform for corporations would help.
So maybe that's the motive behind it, is to create another demand source for our paper.
I think it's, I would strongly suspect that that's at least a consideration, if not a primary consideration.
So what are the implications that you're looking for, Luke, as we start to wind down a little bit here? We have parabolic moves in global bourses. We have 10-year creeping higher, but really not making much headway towards higher rates. What do you think is going to be a trigger? I actually noticed a tweet the other day that part of the new sanction regime with North Korea was that we were going to take any banks that do business with them out of the dollar system. And there was a tweet about a Chinese bank that may be sanctioned for doing this. I know that China and Russia already have an alternative to the SWIFT system. So could it be something geopolitical that lights a fuse on this, and the mean reversion? I suspect you're talking about asset prices begin to deflate based upon that.
The short answer is yeah. I think it could be a geopolitical, absolutely could be a catalyst. You certainly saw geopolitical catalysts to currency changeover. When we got the petrodollar system, you had some a number of different geopolitical catalysts in the early 70s.
Wars and a depression.
Yeah, exactly. And so, yeah, but I to me, the mean reversion is, the U.S. is starting to have to play by the same balance of payments rules that every other nation on the planet has always had to play by for basically all of history. I mean, if you look back, if you look back, for basically all of recorded history up until 1971, the nation that had the best terms of trade, the most surpluses and the biggest reserves had the best currency, and that's thousands of years. And then for the last 46 years, the nation with the worst balance of trade and the lowest pile of reserves had the best currency. And so everyone thinks the last 46 years have been normal, and the reality is the mean reversion is I think if once FX reserves stop rising, that begins putting pressure on the world to start moving back towards a balance of payments centric system. And then if you look at global currencies,
that dollar bearish?
Oh, horribly.
Okay.
The dollar's not priced in the right zip code if we actually go back to a system that's more based on balance of payments and less on balance of payments and reserve, and less on the dollar as global reserve currency.
Okay.
Yeah, you'd rank them by, in theory, you would see the dollar fall against the yuan, dollar against the euro, dollar against the yen, dollar, against the pound. It depends on how they manage Brexit, how they,
right,
geopolitically tie with their fortunes with, China, etc.
Does this also mean higher taxes, even though we're being promised with the right hand lower taxes and with the left hand sunsetting those advantages, and also cuts in social programs?
I think that's where it has to go. I mean, I think it's an unenviable position to be a politician in Washington these days, because you're sort of here, at the tail end of the party, and sort of nothing good can happen because, again, what we're talking about here is when FX reserves are falling, the U.S. government is being defunded. And so, yeah, I think we'll get more things like, Operation Iraqi Freedom, which, that's what it was called. I'm not sure that, that was aptly named. I think we'll get more things like the Affordable Care Act, which did make healthcare more affordable, but it made it more affordable for the government, not for us.
You think there'll be wars? Previously, there's been wars for hegemony when Saddam wanted to be paid in euros, et cetera, et cetera. Although China would be a much bigger adversary than anything we've ever faced before to defend hegemony.
I think, yeah, historically, right. If you read, Graham Allison's and others' work of Graham Allison, I've not read the whole book. I've read a number of articles of Thucydides' trap. That yeah, historically, these types of currency transitions or hegemon transitions have resulted in that. The thing about that is it's that would only accelerate things like because the reality is due to the dollar-centric system, America has not paid for its own wars since World War II. And they've been funded by the Europeans in the case of Vietnam, and then the global war on terror was in no small part funded by China. You go to war with China and Russia aren't going to fund that war. And so if we have to fund our own war,
we're broke.
Oh my gosh, it would be so dollar bearish. Inflation rates would explode. You'd have to ration, gasoline. I remember going through my father-in-law when he passed. His mom had, ration coupons for gas and for rubber and for food. And now you're talking about a country who has basically moved away from cities that actually have public transportation and moved to regions and cities that basically can't function without a steady supply of cheap gas.
So I'm going to ask you this. You have this belief, and I wish I didn't know some of these things, Luke. You ever feel that way, that sometimes ignorance is bliss? So yes. I'm assuming you're still in the Midwest, in the Cleveland area.
Correct.
I'm from Chicago.
Okay.
What are you doing for your own wealth preservation? I'm not going to ask you what you're telling clients to do, but what are you doing, and do you plan to ride out this transition in the Midwest in the USA?
The short answer is yes, I do, but I'm watching closely and I don't know what I'm watching for per se, but I think I'll know it when I see it.
Yeah, how about like going to an ATM and it doesn't work? Would that be a market tell?
That would start to be. For sure. Look,
so are you an accumulator of physical gold? I'm not going to ask you for your address. How are you hedging yourself for what your beliefs for economic conditions down the road?
Like I think I am positioning myself in sort of somebody who reached out to me and highlighted, hey, have you ever seen or read about Jacob Fugger from I guess 300-400 years ago, and just his sort of allocation, which was call it a quarter cash, a quarter gold, a quarter equities, and a quarter productive real estate. And it was an allocation that made its way through all kinds of tumultuous times and progress and distress. And it's actually, the person pointed out to me that it influenced. This person said it influenced Ray Dalio's thinking in the all-weather, his all-weather portfolio. But to me, because the timing is uncertain, to me that's how I sort of have thought about my own portfolio. Maybe the gold is a little smaller, maybe the equities are a little higher. But I ultimately think, when you look at what we're seeing in markets, what I'm seeing develop, if you use this, okay, the U.S. is moving more towards, deficits matter for the first time in a long time. It makes sense that we're seeing these parabolic moves in global risk markets, because ultimately, if I described what I described, if we use this emerging market lens, and we were talking about Argentina, if you're a trader, if you're an investor, what you do, the path is very straightforward. You get your money out of Argentine pesos and you move to dollars. The challenge is that we're talking about the dollar, and so if you got to get away from the dollar, where do you go? There's no other market big enough to take. You don't go into treasuries. That's just out of the frying pan into the fire. So where do you go for safety? And I think
maybe that's what's behind crypto.
I think it's behind crypto. I think, I think there is some element of crypto that's we have the black market Venezuelan bolivar rate. I think there's some element of what Bitcoin's doing that is a black market dollar rate, because there are no derivative markets attached to that, like there is with gold, that change the pricing mechanism as a pure supply demand. Not saying it's not frothy per se at any given moment, but I think there's an element of that. But in terms of really big money, you can't go into Bitcoin, you can't go into gold. So where do you go to get out of dollars? You can't go into Swedish kroner. So I think you go into big cap U.S. equities. I think that's what you do, because now at least you're hedged against the dollar, and you're still collecting a coupon. And I think that if you look back to fall of last year, right after Donald Trump got elected, the S&P 500 over the TLT, if you go on a really long-range chart, 25-year chart, it was a clear breakout, an explosive breakout. And to me, I think that was the first sign of, oh my God, this populism is real. This is not just something happening over there. It's happening here. We're going to have to print all $100 trillion we owe everybody. I got to get out of, because remember, we had a big bond sell-off right then too, right? That's brought under control since. But
still trying to recover from that, and we haven't. But so it ends up where a lot of gloom and doomsters say stocks are going to have trouble. It ended up being the best hedge out there.
I think that's what we're seeing, and I think we're going to continue to see that, in no small part because look, if the policies of the U.S. government over the last 25 years have made it such that the U.S. government and the U.S. consumer is intensely dependent on asset price inflation for consumer spending growth, and of course, consumer spending is 2/3 of the U.S. economy, and through that link. Both through that link and directly via capital gains and options and IRA withdrawals, Alan Greenspan said in 2015, if stocks have become a large part of a surprisingly large part of U.S. federal tax receipts, if stocks just stop going up, let alone fall, the U.S. government will quickly have a fiscal problem. And so it is. They've set up the system where the stock market's become fundamental.
Luke, it's really been enlightening talking to you, and great insight into that. Eventually the U.S. and we're moving in that direction. The free lunch is disappearing, and paying the piper is what's next. And thank you for bringing this awareness to our community. And I wish you all the success in the world with FFTT. And really glad I reached out to you on Twitter, and glad to call you my trading warrior brother going forward.
Thank you very much for having me on. I really enjoyed talking with you, and it was a real pleasure. I look forward to staying in touch going forward.
Okay, let's get back together down the road and see what's happening with reserves, especially after the Chinese oil exchange opens. That should be great. Okay, thank you so much, Luke. Merry Christmas, Happy New Year to you and yours.
Thank you, Dale. Merry Christmas to you too, and Happy New Year as well.
Thank you, buddy.
All right, take care.
That's it, Face. See everyone tomorrow. Remember, don't just count your pips, count your blessings. I hope everyone enjoyed Luke. Great analysis today by Blake, doing some mentoring, and Steve, and we'll see you tomorrow. You're very welcome, Kareem. Adios, my trading warrior brothers and sisters. See you, Madrid. See you, Richard. See you, Val. Thanks again, Luke.